Welcome everyone to the Introduction to COBRA, FMLA, and Other Federal Mandates. Thank you so much for joining us. The Benefits Compliance team will be answering the questions you sent through the Q&A today. We'll try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We'll be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday you'll receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'll hand it over to Kelly Ekman, Vice President of Benefits Compliance at NFP, and Patrick Myers, Vice President and Counsel of Benefits Compliance at NFP. Kelly, the floor is yours.
All right, thanks, Amber, and thank you everyone for joining us for our June GetWise Wednesday webinar series. As you'll see by the title, this is another in kind of our introductory series. So we've been taking many months this year so far to kind of take a closer look at some of the basic topics that affect our employers on a day-to-day basis and kind of hitting these from a high level. So again, today we're going to look at COBRA, FMLA, and other federal mandates. Okay, so here are Patrick and my lovely faces. So as a reminder, we have this for all of our webinars. So the information we're talking about today is for general guidance purposes only. So it is not tax advice. It is not legal advice. If you do have questions of that nature, please consult with your own legal counsel. And the information we're talking about is current as of today. Okay, so our agenda, we said this is kind of a catch-all or a kitchen sink. So we're going to look at the basics on COBRA, Medicare, FMLA, and then we'll end with a little miscellaneous category. So we'll look at TRICARE, USERRA, medical child support orders, transparency rules, and then we will give you some key takeaways and resources to consider for the future. And so Patrick's going to go ahead and get us started with COBRA.
Thank you, Kelly. Hello, everyone. COBRA is the abbreviation for the Consolidated Omnibus Budget Reconciliation Act of 1985. You can all see why we decided to call it COBRA instead. This is the act that requires employers that sponsor group health plans to offer continuation coverage to employees, their spouses, and their dependents in certain circumstances under which they would otherwise lose that coverage. So one of the things we want to ask is which plans, healthcare plans, are actually subject to this requirement. Now, this COBRA applies to all public and private employers, but it doesn't apply to governmental plans or church plans. Employers with 20 or more employees are going to be subject to COBRA. So there is an exception for those employers that have fewer than 20 common law employees. And you count those as 50% of your total employee workforce is fewer than 20 employees during typical business days in the previous calendar year. And when you're counting employees to determine whether or not you meet this small employer exception, you need to count everyone, not just those plan participants. And then you also want to count employees of all the related employers. So if you're in a controlled group, all the employees of the other employers that are part of that group have to be counted. And indeed, you need to also count the part-time employees on a pro rata basis, and you need to count employees outside the U.S. So it's a pretty inclusive group that you have to count in order to determine whether or not you meet that small employer exception. Now, if you meet that minimum employee requirement in the middle of the year, then the employer would be obligated to comply with COBRA the following calendar year, even if that number dips below 20 after you've made that count. And the other thing you want to keep in mind is to note that if an employer's workforce count newly falls below that 20 employee threshold, such that they are not subject to COBRA in the following calendar year, employees whose trigger events occurred when the employer was still subject to COBRA retain those COBRA rights. So in other words, if they've got COBRA coverage, they don't automatically lose it just because the employer falls below that 20 employee threshold. This is true even if their COBRA commencement date falls in the following calendar year. So if they'd qualified it for COBRA while the employer was still above that 20 employee threshold, then they're still entitled to that COBRA coverage even if it falls below that threshold. Next slide, please. So this is a snapshot from our publication that covers COBRA basics. When this snapshot is a chart that highlights some of the more common coverage types that we find in benefit plans and whether or not they are actually subject to COBRA. So the usual suspects here, as you can imagine, are subject to COBRA: your medical, your dental, your vision. But there are some exceptions: a disability, group term life, and the like. And then there are some that are kind of on the fence. And if we go to the next slide, we'll talk a little bit more about some of those exceptions. The FSA is an exception in that the COBRA coverage obligation rights apply only to those FSAs that are underspent. And by underspent, we mean when the participants' remaining balance in the FSA, which is to say their annual election minus any reimbursed claims, if that number exceeds the maximum health FSA COBRA premium that can be charged to the end of the plan year, then that person is entitled to FSA through COBRA. Another exception that's common are point solution programs. Point solution programs can be subject to COBRA as well as ERISA, HIPAA, and the ACA if the program provides medical care. Now, while the analysis about whether or not something provides medical care turns on the particular service provided through each unique point solution program, it essentially boils down to whether the program provides individualized diagnosis, treatment, or prescription services as opposed to a program that provides just behavioral coaching, education, broad-based exercise, or some other general health recommendation service. We do have a publication that covers point solution programs in more depth and gets more into the weeds about that analysis, but it's something to keep in mind when you're trying to figure out whether or not a point solution program in your plan is subject to COBRA. Now, I mentioned that disability is often not subject to COBRA and this is because they generally don't provide medical care. That said, some disability and fixed indemnity plans do include an additional coverage component, such as a rider to the plan or embedded within it that provides medical care. So, like disease-specific plans, EAPs, and wellness programs must be scrutinized for whether they provide that medical care, just like in point solution programs. The medical care coverage component of the plan would be subject to COBRA. So employers should review their specific plan designs with an attorney if they have any questions about that. Next slide, please. So now that we know which plans are subject to COBRA, a question that we can then ask is, who must be offered COBRA? Well, people who are offered COBRA are called qualified beneficiaries, or QBs for short. And a qualified beneficiary is anyone that is covered by the plan immediately before a qualifying event, which is a concept I'll get into shortly. But a qualified beneficiary can include the employee, of course, the spouse, and the employee's dependent children, or any children born to or adopted by a covered employee during COBRA enrollment. Now, this does not extend to domestic partners or tax dependents who are not dependent children. That said, a domestic partner covered by the plan prior to a COBRA event can enroll in COBRA along with that qualified beneficiary, but it's important to note that that domestic partner does not have independent rights to elect COBRA like spouses and dependent children do. If a qualified beneficiary is offered a COBRA election but chooses not to elect COBRA, then they will not be a qualified beneficiary upon the expiration of the election period. So they basically get one shot at it, and once that time period has passed, then they'll get another shot at it. And another thing to keep in mind is that each qualified beneficiary, that is to say, the employee, the spouse, or the dependent children, each of them have an independent election right to COBRA. So you don't need to have the covered employee make that election. The spouse can do it independently, or the dependent child can make it independently. Now, employers can be more generous about who they offer COBRA to, but in order to do that, they really need to get the approval of either their carrier if they're fully insured, or their TPA or stop-loss carrier if they're self-insured. Next slide, please. So now that we've established who can be offered COBRA, what kind of coverage can they be offered? Well, qualified beneficiaries must be given an opportunity to elect the same coverage that they had just before the qualifying event under each benefit and coverage option. So that coverage must be identical to the coverage provided to similarly situated beneficiaries under the plan. Now, they start off with the same coverage they had before they started, but they can change that coverage under certain circumstances. For instance, when active employees make changes during open enrollment, well, COBRA qualified beneficiaries can also make changes during open enrollment. And just like active employees, um, covered qualified beneficiaries have special enrollment rights under HIPAA to add family members under certain circumstances. And if, for instance, a region-specific plan fails to be of value to a qualified beneficiary, say, for instance, the qualified beneficiary moves out of the area, or there is the region-specific one folds or whatever, then the qualified beneficiary has the option to elect coverage that they can use. Similarly, if the employer modifies the plan at any time during the year, then a qualified beneficiary has the right to make adjustments to their elections so that, again, that coverage can be of value to them, just like active employees would have. Next slide, please. So when can qualified beneficiaries be offered this COBRA coverage, and how long can they enjoy that coverage? Well, there are qualifying events, which I've touched on earlier, that must occur in order for the qualified beneficiary to get that offer of coverage. And they have two components, basically. Qualifying event will have a triggering event, which is one of a set of specific events that must occur. And that triggering event must cause or will cause a loss of coverage. So as we see here on the slide, we have a list of these qualifying events. And each qualifying event will have an attendant coverage period. So that's how long that person can enjoy that coverage as a result of that particular event. So we've got termination of employment, which is probably the one you're thinking of, either voluntary or involuntary. Once someone loses their job, they're no longer eligible for coverage as an active employee, and so therefore they are entitled to an offer of coverage through COBRA, and they can have that coverage for 18 months. Similarly, if you have a reduction of hours such that it results in a loss of eligibility under the plan, so for instance, if you go from a full-time position to a part-time position and part-timers are not entitled or eligible for coverage, then that is also a qualifying event that will entitle that qualified beneficiary for 18 months of coverage. If the covered employee and the spouse divorce or have a legal separation, that would entitle the spouse to a COBRA offer of COBRA coverage that could last up to 36 months. Similarly, if a covered employee dies, then the spouse and the dependent children can get that COBRA coverage for 36 months. And when a dependent child ceases to be a dependent anymore, then they are also entitled to an offer of COBRA coverage for 36 months. And when an employee becomes entitled to Medicare benefits, if that entitlement results in a loss of eligibility, and this is important because this is rarely a qualifying event when health plans that are subject to COBRA, which is to say, as we recall, having 20 or more employees, they're also usually subject to Medicare secondary payer rules, which prevents employers from terminating an active employee's coverage because of Medicare entitlement. So typically, when someone becomes entitled to Medicare, that does not necessarily result in a loss of loss of eligibility for active employee coverage because of those Medicare secondary payer rules. But if that does happen, then that person is entitled to an offer of COBRA coverage for 36 months. And then finally, if a employer has bankruptcy, then retirees are entitled to a offer of COBRA coverage. And so retirees are the dependents, actually. Now, these retiree qualified beneficiaries will have the right to elect COBRA continuation coverage following a bankruptcy if the employer or any member of its control group continues to offer any group health plan. Now, again, this is specific to retirees and their dependents. Bankruptcy alone is not a COBRA triggering event for active employees or their dependents. So those are something to keep in mind when you're thinking about what qualifying events could qualify someone for an offer of coverage. Now, again, each of those events has a certain period of time under which or during which they can a qualified beneficiary can enjoy that COBRA coverage. But a thing to keep in mind that is if a person is terminated from employment due to gross misconduct, that does not trigger an offer of COBRA coverage. Now, unfortunately, COBRA does not define what it means when it says gross misconduct. This is an employment law issue that if there's ever an issue about that, the employer should consult with their employment law attorney to determine whether or not this would be if they have to terminate somebody for gross misconduct, if that is going to be sufficient to basically disqualify that person for an offer of COBRA coverage. Now, those durations, those time periods under which they can enjoy that COBRA coverage can be extended under two circumstances. There's a disability extension, and then there's a multiple qualifying event extension. Under the disability extension, can be an extension that can extend the coverage to 29 months in the event of a qualified beneficiary being determined by the Social Security Administration to be disabled. Now, there are two conditions that have to be satisfied for this extension to take place. First, the qualified beneficiary's initial COBRA triggering event must be either their termination of employment or their reduction of hours. Second, the Social Security Administration must determine that the qualified beneficiary is disabled at any time during the first 60 days of that COBRA coverage. Now, note that the qualified beneficiary's disability determination date, that is, when the disability began, may have actually occurred before the COBRA effective date. Otherwise, just keep that in mind when you're thinking about those two conditions that have to be satisfied for that particular type of extension. Now, the multiple qualifying events extension also has two conditions. First, the second qualifying event must be either the death of the covered employee, the divorce or legal separation of the covered employee and spouse, the covered employee's Medicare enrollment, which again is rare as we discussed earlier, excuse me, or the loss of dependent child status under the plan. The second condition is that that second qualifying event must cause a loss of coverage in the absence of the first qualifying event. In other words, if that second qualifying event by itself would have led to a loss of coverage, then that would satisfy that second condition. So those are two possible ways that those standard coverage duration coverage can be extended. And that multiple qualifying events extension can extend it up to 36 months, I should add. Now, as those things the coverage can be extended, it can also be shortened. And that can be shortened for reasons such as when the qualified beneficiary misses their payments, or when the employer ceases to operate their plan, or when Medicare entitlement occurs after the qualified beneficiary elects COBRA. And spoiler alert, Kelly's going to talk a little bit more about this when she goes into Medicare a little later. Next slide, please. So before we go on, I wanted to talk a little bit about measurement periods because this might have an effect on whether or not there's a loss of eligibility on the occurrence of a triggering event. Now, under a look-back measurement period, employers can track variable hour employees using the look-back measurement period to determine whether or not they're full-time employees, at least for purposes of the ACA employer mandate, meaning that they work at least 30 hours per week over the measurement period. And once that full-time status is determined, it's generally locked in for the subsequent entire stability period. So if an employee has a reduction of hours, that is, they're transitioning from a full-time position to a part-time position during a stability period, their full-time status, as was determined during the measurement period, is generally locked in. So they haven't lost that eligibility for coverage, so there's no COBRA. And if they fail to pay premiums and coverage terminates, it's not a COBRA event during that stability period. Now, if the employee is terminated from employment during the stability period, that is a COBRA event. And in this slide, we have a snapshot from one of our publications that goes into employer mandate measurement methods in much greater depth. But I wanted to touch on that just because as it is relevant to whether or not there's a loss of eligibility for purposes of an offer of COBRA coverage. Thank you. Next slide, please. So how much is this going to cost? Well, federal COBRA allows employers to charge up to 102% of the applicable premium for COBRA continuation. And if you've got that disability extension I talked about earlier, they can charge up to 150%. Now, the applicable premium for this purpose is going to be the cost to the plan for the period of coverage for similarly situated beneficiaries. Now, the cost to the plan is going to be the total cost of both the employee and employer paid portions. And when you include the cost of providing coverage for both active employees and COBRA, when you're determining how much to charge. And the other thing to keep in mind when you're talking about cost is that that COBRA premium must remain fixed for a 12-month period. Next slide, please. Now, this slide talks about or gives you a snapshot of the different notices that are required when it comes to administering COBRA for qualified beneficiaries. Won't get too much into the weeds on this, but just note that there is an initial notice that must be distributed within 90 days of coverage for both covered employees and their spouses. Wanted to note here that it is not a good idea to distribute those initial notices with new hire packets or open enrollment guides, because these needs to go to people who are first covered by the plan, not just anybody who may merely be eligible for coverage by the plan. The other thing to keep in mind here is that many employers engage vendors to do their COBRA administration for them, but they might not necessarily assume responsibility for distributing this initial notice. So you want to make sure that this notice is distributed timely to the right people at the right time, because the vendors may not necessarily be doing that for you. The other thing to note is that the election notice, which is to be distributed to the qualified beneficiary on the occurrence of those qualifying events. Timing here is also pretty important. Not to get too into the weeds on this, but just note that typically, if you've got a situation where you've got a single employer plan under which the employer and the plan administrator are usually the same entity, the employer effectively has basically 44 days from the date of being notified of that qualifying event by the qualified beneficiary to provide those election notices to the qualified beneficiaries so that they can then make that decision whether or not they want that COBRA coverage. And again, most of the time, the vendors are going to be distributing these notices. So it's a good idea to touch base with those vendors from time to time to make sure that they are distributing those notices at the right time and to the right people. Next slide, please. And finally, I wanted to wrap up the discussion on COBRA for our overview today with a brief discussion of state mini COBRA laws. Many states have their own state continuation laws, and they're going to vary by state in both employer eligibility and duration of continuation. But generally, these laws are going to apply to plans that have fewer than 20 employees, but they can also apply to those larger fully insured plans and provide more generous benefits than are required under federal COBRA. For instance, both California and New York apply to fully insured plans of all sizes and can extend that duration, that coverage, up to 36 months for that medical coverage only. In addition, Texas employees that exhaust their federal COBRA can get up to additional 6 months of additional state continuation, even if for those events that already provide 36 months of coverage. Now, again, this usually applies to those fully insured plans and those policies that are issued by the states, the particular state that has issued that state continuation or promulgated that state continuation law. So they don't generally apply to self-insured or level-funded plans, although there are a couple of states, like I believe Vermont and Louisiana, that say that they do apply to self-insured plans. So if you have a plan that's been issued in either of those states, or you are self-insured and you're in either of those states, then it's a good idea to check to make sure to see whether or not those states are going to, those states' state continuation laws are going to apply. Now, some states will further limit, say, administrative fees or prohibit surcharges. They may have additional notice requirements, or they may have or require a conversion option. So it's a good idea to check with those laws to make sure that the continuation that's being offered to the qualified beneficiaries comply with those laws. And so to that end, it's important to work closely with insurance carriers to understand your obligations for those states in which you have employees. Next slide, please. So that wraps up the overview on COBRA. And so I'm going to go ahead and pass this on over to Kelly to talk more about Medicare.
All right, thanks, Patrick. And yeah, we'll start our Medicare overview just with a quick look at, what is Medicare? Sometimes people get confused between Medicare and Medicaid, but Medicare is what we're talking about. It's the federal health insurance program for those who are 65 and older, or if they are considered disabled by Social Security. The big thing to remember here is just because someone is 65, it doesn't always mean that they have to enroll in Medicare. It's actually going to depend on the specific circumstances of that person and whether or not they have access to employer coverage. And then here's a little chart if you want to look at it later, just kind of going over the different parts of Medicare in case you're not familiar with those. So we're going to take some time to cover something called Medicare secondary payer rules. These are really important for employers offering group health coverage. So the purpose of these rules are to prohibit employers from offering financial incentives to anyone who is Medicare eligible. So trying to entice them to enroll in Medicare instead of the group health plan. That's kind of the main point of these rules. And so the Medicare secondary payer rules, they're going to apply to employers with 20 or more employees for each working day in at least 20 weeks in the current or preceding calendar year. So I know Patrick talked about COBRA, which also has a 20 employee threshold. This is just going to apply that rule a little differently. Now, the threshold does change a little bit if it is Medicare due to disability instead of Medicare due to age. Then that threshold is actually 100 or more employees. And that's based on having 100 or more employees on at least 50% of its regular business days in the previous calendar year. So the rules change a little bit depending on if it is Medicare for the working aged, which is 65 and older, or for disability. And then if Medicare coverage is due to end-stage renal disease, the rules are different again. There are no size restrictions. All plans actually have to comply with coordination of benefit rules for the first 30 months of that diagnosis. So why are these rules important? Well, they're important because they're going to determine whether the group health plan pays primary or secondary. So if somebody has both Medicare and the group health plan, these rules are going to determine that. And then it's really important for those employers with 20 or more employees because that's going to impact their ability to try to pay for someone's Medicare coverage. So if an employer has 20 or more employees, they cannot reimburse or pay for the Medicare coverage for their employees unless they utilize an ICHRA. And some of you may be familiar with ICHRAs, but the key here with the ICHRA is that would have to be offered to all employees within a specific class. So you still can't just single out those who are Medicare eligible. So the big thing there is to remember that, you have to treat Medicare eligible employees the same as your employees who are under 65. Now, if you're an employer who offers an opt-out or a cash in lieu arrangement, so something where if somebody declines the group health plan, they get a taxable cash amount instead. That is still within these Medicare secondary payer rules as long as all eligible employees are eligible for that. So again, you can't just say only those who are Medicare eligible can get this opt-out. It would have to be all eligible employees. Now, Medicare plans can be offered to retirees because, again, retirees are different. They're not active employees. So these Medicare secondary payer rules aren't going to apply. So if you have a retiree plan, you can sponsor Medicare offerings. And there can be pretty big penalties for employers that are not complying with these rules. So it's really important that if you have 20 or more employees and are subject to these rules, that you are not trying to incentivize, force, or otherwise entice employees who are of Medicare age to choose Medicare over the group health plan. Now, another part of Medicare that most of you are probably familiar with are the Part D requirements. So D is in drugs. That's how we think of prescription drug coverage under Medicare. And so employers have two different obligations under these rules. So the first one is a notice to eligible employees. So by October 14th of each year, there is a notice that should be given to employees. If you're a non-calendar year plan, it's a little different. Typically, you're going to provide that during open enrollment, but then we would also recommend supplying it again close to that October 14th deadline. So that notice is going to inform individuals whether or not the plan is considered creditable or not. And that information is important because it's going to help someone who is enrolled in Medicare know if they need to buy a Part D plan or not. Because if they're on Medicare, they need to have creditable drug coverage, and they can either get that from the group health plan if it's creditable, or they may buy a separate Part D plan. So it's really important information for individuals. Oftentimes, the carrier or your TPA will provide that creditable or non-creditable status. However, if that does not happen, then you will need to seek an actuarial determination of the plan so that you can make sure you are giving employees and their families accurate information. The second employer obligation under these Part D rules is the disclosure to CMS. So an online disclosure is due 60 days following the start of a plan year. So if you're a calendar year plan, I always say by the end of February is when you should be doing that. And basically this just reports to CMS whether or not your plan or plans are creditable or non-creditable, and then the number of individuals you expect to be covered under that plan. If for some reason your creditability status changes mid-year, then you would need to file an updated disclosure. That doesn't happen too often, but maybe there was some misinformation or the plan actually did change mid-year, then you would need to update that disclosure. Okay, so then we're going to say, well, how does Medicare work with other laws? And we're just going to hit these at kind of a high level. So HSAs, so one of the common ones here. Once an employee or an individual is enrolled in Medicare, they can no longer make HSA contributions. The employee can't make those contributions, and neither can the employer. And that's because Medicare is considered impermissible coverage for HSA eligibility. And as you may know, HSA eligibility is based on the individual status as of the first day of each month. Now, one thing that can trip people up is Part A is retroactive up to 6 months, although no sooner than the month in which you turn 65. So if you have someone who delayed Medicare enrollment, let's say until age 67, and then they decide to enroll in Medicare, but they're still on the group health plan, their Part A coverage is retroactive 6 months. So that now will make them ineligible for HSA contributions for that 6-month time period. So it's really important that if someone enrolls in Medicare after age 65, they need to, keep this in mind when they are making their HSA elections. Now, what happens if the employee is not enrolled in Medicare, but the spouse is? So that's not going to impact the employee's ability to contribute to an HSA. And that's because HSAs are individual tax accounts. The contributions are based on the tier in which you're enrolled. And it doesn't matter if the other person that you cover is enrolled in Medicare or some other type of impermissible coverage. What's important is that you, as the account holder, are not enrolled in that impermissible coverage. An existing HSA can be used to pay for your spouse's qualified medical expenses. So even if they're enrolled in Medicare, you can still pay for their medical expenses. You can actually use those HSA funds to pay for Parts B, D, or Part C, which is often called Medicare Advantage. You can use those HSA funds to pay for that. Importantly, you cannot use HSA funds to pay for a Medicare supplement. And then, of course, just normal medical expenses. Medicare is not going to cover dental and vision coverage, so you can use an HSA for those as well. The next interaction we're going to have here are mid-year election change rules, or qualifying life events, as many are familiar. So enrollment in Medicare can create a mid-year election change event, but only for the person who actually enrolls in Medicare. And that's because the election change rules must meet Section 125's consistency rules. And so in this example here, so if a spouse enrolls in Medicare, but the employee does not, the employee can't drop their own coverage because they didn't enroll in Medicare. But they could drop the spouse's coverage because that spouse is choosing to go on Medicare and drop the group health plan. Similarly, with that consistency rule, if my spouse drops to enroll in Medicare, I can't then add my adult dependent because of that. That's not going to meet those consistency rules. So the requests that someone wants to make, so the actions they want to take, always need to comply with Section 125 rules for mid-year election changes. And now, as Patrick alluded to earlier, Medicare and COBRA can be quite confusing, and he covered a lot of this, so I'm just hitting it at a high level. But again, as he mentioned, if the employee enrolls in Medicare and they are still an active employee, it does not create a COBRA qualifying event for a covered spouse or a dependent. And that's because of those Medicare secondary payer rules that I talked about. Because those rules say you can't terminate someone's group health coverage just because they enrolled in Medicare, it then does not create this COBRA event. And sometimes that can feel a little weird because let's say the employee decides to drop the group health plan in favor of Medicare, it doesn't feel like the spouse or dependents are voluntarily dropping their coverage. But that's actually the way it works. And that's because the employee could have remained on the group health plan and continued to cover that spouse and dependent. They just chose not to. And we've got a link here to a recent FAQ that we wrote in Compliance Corner that goes into this in further detail. So definitely check out that link when the slides are sent. And then, as Patrick mentioned, we do have our COBRA guide for employers that will go into the weeds on this topic a bit more as well. And also, like Patrick mentioned, how long COBRA is offered or if it's offered will be dependent upon when the person enrolls in coverage. So again, I always like this little graph here. So if we're talking about the employee, if they enroll in Medicare before their COBRA event, so let's say before they retire or terminate employment, they would be offered COBRA. If they enroll in Medicare after COBRA, then COBRA may terminate early, but again, only if the plan rules say they can. So you have to dig into your plan a little bit more. And I think Patrick mentioned too about the extension of COBRA coverage and how it rarely creates a second qualifying event. So these rules can be really challenging to go through. So I definitely recommend taking a look at the toolkit and publication that we have. The big thing here is that, if the employee enrolls in Medicare prior to retiring or terminating, then the maximum coverage period can be 36 months, but it is measured based on the month in which the employee enrolled in Medicare. So it's not going to be based on the date that they actually, retired. Let's say if they enrolled in Medicare 6 months prior to retiring, the 36-month countdown starts that month where they enrolled in Medicare. But if they terminate coverage or retire or terminate employment or retire prior to enrolling in Medicare, then that spouse or dependent, they're only going to get that 18 months of coverage. They're not going to get 36 months, just like Patrick mentioned earlier. And so now Patrick's going to take us through an overview of the FMLA.
Thank you, Kelly. The FMLA is a federal requirement. It's short for the Family Medical Leave Act, and it applies to private employers with 50 or more employees. It also applies to governmental employers as well as public and private schools of all sizes. Even with an employer that is subject to FMLA, employees of those employers are themselves eligible to take that leave if they've worked for the employer for at least 12 months and they had 1,250 hours of service in the prior year. And in addition, they have to work at a location where the employer employs at least 50 employees within 75 miles of a work site. This leave is job protected, and health benefits are continued under the same conditions as if they are working when they're on that leave. Next slide, please. Now, an employee can take this leave for up to 12 work weeks in a 12-month period if they have one of the following reasons. One, the birth of a son or daughter or placement with the employee for adoption or foster care, to take care of a spouse, a son, daughter, or parent who have a serious health condition, for the employee's own serious health condition that makes him or her unable to perform the essential functions of the job, or for any qualifying exigency arising out of the fact that a spouse, son, daughter, or parent is a military member on covered active duty or called to covered active duty status. An eligible employee may also take up to 26 work weeks of leave during that single 12-month period to care for a covered service member with a serious injury or illness when the employee is the spouse, son, daughter, parent, or next of kin to that service member. Next slide, please. Now, there are notices here as well. There's a general notice, eligibility of and rights and responsibilities notice, and designation notice. Often those notices go together. There is a notice of non-payment of premiums and an open enrollment notice. The general notice is typically a poster that's posted in the break room or on the intranet site where employees have ready access to that information. It highlights at a high level their rights and responsibilities under FMLA. And of course, the eligibility notice and rights responsibility notice, as well as the designation notice, is a notice that the employer provides to the employee to let them know that the leave that the employee is requesting is going to be FMLA leave and provides them with a heads up on what their rights and responsibilities are under FMLA. And if the employee fails to pay their premiums while they are on FMLA leave, there is a notice of non-payment that must be distributed to them. And then finally, if the employee is on FMLA leave during open enrollment, they get open enrollment materials just as if they were still actively working and they're not on leave. So those are some important notices that must be distributed at the right times in order to comply with FMLA. Now, during FMLA, health benefits are continued under the same conditions as if they are working. Employees, though, however, are still responsible for their share of the premiums. And if benefits change while the employee is on FMLA, then they are entitled to those changed benefits, much like those qualified beneficiaries under COBRA are also entitled to change their benefits on the occurrence of certain events, just like active employees. Now, coverage can end during FMLA for one of the following reasons. If the employee can choose to drop the coverage while they're on FMLA, although if they choose to drop the coverage, they have to get it back when they return to work. Or if the employee fails to pay their share of premiums, then they can lose their coverage while they're on leave. If the employee does not return to work after their FMLA leave, then the employer is not obligated to continue those benefits. However, there is likely an obligation to provide COBRA election notices when the employee fails to return from that leave, even if the coverage was dropped at the beginning of the leave or during the leave. Next slide, please. So I mentioned that employees are still responsible for paying their share of the premiums. And there are three different ways to do this. They can either pay it up front before they go on leave, which is admittedly pretty rare because people don't necessarily know how long they're going to be out, or they may not have enough, spare cash lying around to make that upfront payment. They can pay as they go. Usually this can be in the form of if they're taking their paid sick leave or something like that concurrently with their FMLA leave, then that would be a standard, their usual deduction from their paychecks. Or they can pay as on a post-tax basis, just writing a check to pay for their share of the premiums while they're on the leave. And then finally, there is a pay upon return to work option where they basically make it up when they get back to work. Whichever way it's done, the employer should provide advance notice of that method and as well as the requirements and deadlines for making the payments while they're on the leave. The employee cannot be required to pay more than if they were actively working. Now, if the employee agrees to pay their share during the leave, but they fail to do that, then unless the employer has a longer grace period, their obligation to maintain the coverage ends if the employee's premium share payment is more than 30 days late. Now, if the employee misses a payment deadline, That non-payment notice I mentioned earlier must be mailed 15 days before the coverage ends, advising of the termination of the coverage on a specific date if the payment is not received by that date. Next slide, please. Now, much like with COBRA, many states have their own family medical leave statutes, and they are often, like in the COBRA context, these state FML statutes are often broader in application. For instance, some states also cover safe leave, generally leave for an employee or their family member who's a victim of domestic violence, stalking, or sexual assault or abuse, which is not a reason, as you recall, that someone can take that federal FMLA. Now, the family relationships that are recognized under statutory programs will vary from state to state and will often include relationships such as domestic partners, siblings, grandparents, and grandchildren that are not otherwise recognized under the federal FMLA. Employers that are covered by federal FMLA and or a state's version of FMLA will run such leave concurrently whenever the qualifying reasons for leave is the same. And then state FML laws may also provide partial wage replacement to eligible employees, which is not something that the federal law does. Now, in this slide, we also included a snapshot of a chart that we maintain. It's a publication that we have for state disability and paid family leave statutes. That's excellent resources that breaks down many of these, the different aspects of these laws and compares them. Next slide, please. So at this point, I'll pass this back over to Kelly to cover other federal mandates.
All right, thanks, Patrick. Yeah, so this is kind of just the catch-all part, and don't worry, these aren't all of the mandates that an employer needs to be aware of. We just wanted to kind of pick and choose a few that maybe don't get talked about quite as much, but are still important things to have on your radar. So again, as I mentioned earlier, we're going to talk about USERRA, TRICARE, medical child support orders, and then some of the transparency rules that hopefully are a bit top of mind for those attending today. So first, we're going to start with USERRA. Hopefully, you've all heard of this one. So it's the Uniformed Services Employment and Reemployment Rights Act. So this is related to active military service. And so USERRA rules apply to all employers regardless of size. So I know we've talked about size requirements for several different mandates earlier, but this is going to apply to all employers. The DOL does have a model notice about USERRA leave, and so we do have a link here for that. So what is USERRA? What does it provide? So it provides protections for employees who are absent from work due to uniformed military service. So what do they need to be provided? They should be offered the option to continue group health coverage at their expense for a period of up to 24 months. So think of it sort of like COBRA coverage in the sense of they would be paying that entire cost. USERRA is going to guarantee reemployment rights upon return from service, and then reinstating healthcare coverage upon return as well. So not all employees are going to fall under USERRA. It's going to be those who have a period of leave that's 31 days or longer. So if you have employees who are on some sort of uniform service leave and the absence is 30 days or less, then things are just going to continue like normal. Their coverage is going to continue like normal. They're going to pay the normal active employee premium rates. It's just if that leave is going to be 31 days or longer, that's where USERRA is going to kick in. The next one we're going to talk about here is TRICARE. Again, so it's another military healthcare program. So this is providing benefits for active duty or retired service members and, of course, their families. So TRICARE has protections that are very similar to those Medicare secondary payer laws that I talked about earlier. So it's going to apply to employers with 20 or more employees on each working day in each of 20 or more calendar weeks in the current or preceding calendar year. So again, TRICARE protections don't apply to all employers, but it's going to apply to a good portion of them. So similar to Medicare secondary payer laws, again, employers cannot incentivize someone to choose TRICARE instead of the group health plan. They cannot force someone to choose TRICARE. They cannot impose any sort of stricter eligibility requirements or different costs. So I always think of these as kind of the golden rule. Treat everyone the same. So even if someone is eligible for TRICARE, they should have the same right to the group health plan as any other active employee. SPD, so plan documents, should disclose information about TRICARE and obviously should list information on a coordination of benefits rules. The next one here, QIMS codes, that's how I say it. Others may say the acronym differently. Qualified Medical Child Support Orders. So these are going to be court orders that are creating a right to enroll a dependent child who is not already enrolled. There are specific rules that have to make these court orders a qualified order. Sometimes you'll also hear about a national medical support notice. Those can also be qualified medical child support orders. Each state is going to have its own rules related to these requirements, and they're all going to have some specific financial requirements that may impact whether or not someone has to be enrolled. So sometimes they'll set a percentage of wages, and if the cost to enroll the dependent exceeds that, they may not need to enroll the child. So if you get one of these, always check with the court that issued the order if you have questions about whether or not the child should be enrolled. An important thing here, so expiration of the coverage period that's provided in the order is not going to create a right to disenroll the dependent. So let's say the order ends when the child turns 18. That's in the middle of the plan year. It doesn't mean that the child gets dropped because the child is still technically a dependent of that employee and therefore should be allowed to continue coverage under the plan. And then obviously at open enrollment, the parent employee would be making that decision. So just because the order expires doesn't necessarily mean that the child should be dropped right at that moment. So always kind of take a step back and look at the facts before disenrolling in that kind of situation. And then the CAA, or these transparency rules that you've heard of. So we just recently passed the deadline for RxDC reporting, so prescription drug collection reporting. And so this was due June 1st. So hopefully those on the call did comply with this. So this requirement is basically reporting information on prescription drug claims and spending to CMS. And so the good news is for fully insured plans, the carrier is typically going to file that, but employers generally would have been asking you for information back in the spring to help support that filing. If you have a self-insured plans, the TPA often files, but you should always confirm. And then again, they still would have been asking you for information. So hopefully everyone did get this done by June 1st, and you are working closely with your carrier or TPA each year on this. The other one here are gag clause attestations. Hopefully you are familiar with this. The big thing here is, it's saying that plans can't enter into contracts that are restricting access to information. So access to provider-specific cost or quality of care information. Sometimes TPAs will try to say that, the information is proprietary, and they would try to have a clause in there that would restrict that access. So basically, plans have to attest each year by December 31st. Fully insured plans, again, the carrier's often filing, but you should always confirm. Similarly, self-insured plans, again, level funded, they can enter into an agreement with the TPA to file on their behalf. But again, never assume that it is being done. You always want to double check on that. And now Patrick is going to take us home with some takeaways and a look at resources.
Thank you, Kelly. Here are some high-level takeaways from our presentation, and thank you for hanging out with us today. First of all, COBRA requirements are prescriptive, so Be sure to talk with your vendors to make sure that they are sending their notices and stuff at the right times. Medicare enrollment should not be influenced by the employer. FMLA and other leaves of absence make benefits eligibility and administration tricky, so just be aware of how those work. Employers should not assume the carrier or the TPA is handling all those transparency requirements. So just like with COBRA, it's a good idea to confirm that your vendors and carriers are doing what they're supposed to be doing. And then counting employees varies by federal law. We've talked about both COBRA requirements as well as Medicare secondary payer rule requirements, as well as FMLA requirements that require a certain number of employees in order for them before they kick in. So the employers with populations on the cusp of 20 or 50 employees should be careful and stay on top of those head counts to ensure the compliance with applicable laws. Next slide. We have mentioned throughout the presentation that we have some excellent publications that cover many of the topics that we covered today in much more depth than we can get into today. So please reach out to your NFP representative and they'll be happy to give you copies of any and all of these publications that we've discussed today. And I'm afraid we're at the top of the hour. So thank you so much for joining us. We hope you have a great rest of your day. And again, if you have any questions, just reach out to your NFP representatives. We'll be glad to help you. Thank you so much.
All right. Thanks, Patrick. Yeah, Amber, go ahead and take us out.
Okay, thanks, y'all. So thank you, Patrick and Kelly, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We'll be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you'll receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you, everyone, for joining us, and have a great day.